In this video, I want to conclude our discussion of estimating the cash flows for capital budgeting projects. So we've already talked a little bit about some of the component parts, but I think the best way to go through this really is to go through a fairly comprehensive example of how we would create these particular cash flows and the predictions. So let's go ahead with this example to see how this thing all fits together. So again, we have a company. I'm going to buy a new piece of machinery. Cost $380. It's $20,000 to install. It's a 5-year asset. Now we're replacing an old asset. It costs $240,000. It's a 5-year project as well, but we bought it 3 years ago. We can currently sell that machine for $280,000. Now the company expects current assets to increase by $35,000 and current liabilities to increase by $18,000. So we're obviously going to have a change in net working capital. And of course, we have our corporate tax rate at 21%. So let's see how we can start this. The first thing we need to do is to take a look at the depreciation of the assets. So again, this comes from our depreciation worksheet in the cash flow statement workbook. But here we have the new asset. Grand total of $400,000 in initial costs. Now I could have put $380 and the 20 here, but I just made it one total. You can do either one. And then for the old asset, it costs $240,000, 5 years. We bought it 3 years ago. There's the tax rate. So this helps us calculate the depreciation. So our depreciation schedule for the new asset is listed here. Here's the depreciation for the old asset. And because we said we bought this 3 years ago, the remaining 3 years of depreciation are shown for book value. And when you total that, we end up with the $69,600 is the book value of the old asset. Now, the process then is we need to copy the new asset depreciation and the remaining depreciation from this depreciation workbook or worksheet, and we need to copy and paste that into the cash flow workbook. So you can see that's what I did here. We've copied those numbers in here. Now make sure when you copy and paste from one worksheet to another, make sure that the numbers show up, right? I mean, if you just copy and paste, Excel typically tries to follow from another worksheet and it makes it a little bit ugly. Just make sure you choose to paste numbers or values. So what this does for us then is it calculates, obviously we have the new, we have the remaining old. You'll see how this works for us a little bit later. It talks about the change in depreciation. So now we have our basis here, right? Here's our new asset. We copied those from before. Here's the salvage value of the old asset. Now the cash flow from the sale of the old asset is calculated right here. So we're going to receive $235,816 from when we sell this old asset. We're going to spend $400. We're going to receive $235. So obviously there is a difference there. So when you follow in this worksheet, and we'll continue to complete this entire worksheet as we go through this example, you'll see that here's our net working capital change. Here's our investment in, or a net investment in plant and equipment. So the total cash flow for the investment is $181,184. So that's the initial investment. And of course, if we did this by hand, done the exact same way. The only thing we would have to do is you would have to calculate the book value here and calculate the taxes separately and in another place, obviously. So again, the initial investment of this project is $181,184. So what about operating cash flows? Now this is where it really starts to become a little bit more complicated, because we need to estimate, typically, especially for replacement projects, two sets of statements. So generally cash flows are not equal, right? They're not equal from time to time. There will be changes. Now, for example purposes, we may make them equal in this instance. However, in the end, cash flows can never be equal year after year after year, because depreciation is never equal year after year after year. So anyhow, that's where we're going with these cash flow terms. And again, we want to understand this is after tax, right? So we can only use after tax cash flows to pay people. So that's what we want to use in the end in valuing our assets and in our prediction. What this essentially, simply how we do this, is to get to after tax cash flows. We calculate the operating income, if you will, and then we add back any of the non-cash charges like depreciation, amortization, and depletion. So we just add them back after we get to net profit. So coming back to our original example we've been following for, this just provides this information for us again, if you will. But here's our new depreciation each year, and here's the old depreciation. So why is it important to do this? Well, we want to know what's going to be different if I do this project. If I don't do the project, next year I'll take a depreciation expense of $28,800. If I do the project, I'm going to take an $80,000 depreciation. Assuming you sell the old one, you're not going to get this again, obviously, but you would have gotten it no matter what happened. So incremental requires us to look at the change. What will be new if I do this thing? So that's why we calculate here, in this case, the change in depreciation. Now, we're going to create income statements so that we can ultimately come up with an operating cash flow and a cash flow after taxes. But one thing we have to explain is that we are not going to include interest in our income statement. And it seems a little bit strange because an income statement by definition should have interest in it. However, just to kind of segue to a later types of videos, when we calculate the cost of capital, the weighted average cost of capital, that assumes financing. The interest costs of financing our projects is incorporated into the weighted average cost of capital. In our capital budgeting techniques, the required return for projects is always based on the weighted average cost of capital. So interest and the costs of financing are incorporated in the decision, but they're incorporated in two different places. In one instance, they're incorporated in the cost of financing as a requirement, and in the other, we're not going to include it there so that we don't double count it. So again, interest is not included in our statements. So here's the project we've been following through with this Powell Corporation's projects. And what they provided us with are some revenues and expenses, excluding depreciation and interest here, for the project if we do a new machine, and then what we think would happen if we just keep the old machine. So in the spreadsheet, we can do this fairly simple just by adding the revenues and the expenses and then putting a formula in so it does a calculation. So now we'd end up with the change in earnings before depreciation and taxes for the project with the for this analysis with the project and then without the project. Now we can obviously do this by hand, right? And do revenues and then subtract the columns by hand if that's something we would want to do. Again, depending on your how friendly you are with Excel, you may want to do it by hand. Nothing wrong with that. It just takes more time. So the next thing we want to do is to ultimately come up with the incremental operating cash flows. We want to complete this process, if you will. So in the spreadsheet, the numbers follow down. Here's the change in the new project's earnings before depreciation taxes. Here's the old project. Here's the change in depreciation. So we have in the end, we have a change in earnings before depreciation and taxes. Subtract out the taxes. And then we have a change in net income. Again, these are all formulas. This calculates out for you in the spreadsheet. That then gives us what we refer to as the change in cash flow after taxes. So at the end of the first year, we actually have a negative income, but we have positive cash flow because of the depreciation. So here we have the line items for years 1 through 5, which are the changes in cash flows after taxes. So currently, although we're not done yet, we still have another item to include here. This is our timeline. We're going to spend $181,000 odd dollars to buy the asset. And then each year, this is our predicted incremental change in cash flows after tax. What we need to do then is to incorporate the end of the project. What happens? We're going to assume that 3 things happen. Number 1, the new assets that we purchased, we're going to assume that we sell them and we liquidate them. We're also going to assume that we need to take into account the old assets. If we hadn't done the new project and kept the old project, we would have had to liquidate the old assets. So we're going to have the cash flows associated with that. And then finally, we need to liquidate the working capital that we had when we started this initial project. So regardless of the type of project, we're often going to have a change in net working capital. We're going to have to unwind that, right? It's going to have to back itself out. So again, here are our basic formulas, right? What's the after-tax proceeds when you sell the new asset? What are the proceeds if you sell the old asset? And then what's the change in working capital? So in the end, the terminal cash flow is proceeds from the sale of the new minus the proceeds from the sale of the old, plus or minus, depending on the beginning net working capital number, the change in working capital. Again, coming back just to remind us, right? It's the after-tax proceeds from the sale of the new and old assets. We have to obviously understand what? The book value. We need to understand the process of eliminating assets. So what we're going to predict, we're going to predict the actual selling price of an asset sometime in the future. Now that's very difficult to do, but we have to have some kind of a number, right? At the very least, maybe we would say that it's worthless at the end. And if it's fully depreciated, then we don't have any problems. But if there's book value left, or if it costs us money to get rid of it, we have to incorporate that in all of our analysis for the ending timelines. Again, just to repeat myself, right? We do have to incorporate changes in net working capital. For the most part, for most problems when we do this, we're just going to assume that net working capital, it increases in the beginning and then we get rid of it at the end. However, there typically are changes throughout the time frame. So, we buy some this year, we get rid of some the next year. So in the end, the liquidation of the working capital truly is just the working capital that we started the last year with. So whatever that number is, that's the number that we ultimately would use in our liquidation calculation. So for this particular project, at the end of its useful life, this new machine, we're going to be able to get rid of it for a net of $50,000, including removal and cleanup costs. The old asset we would have been able to liquidate to get around $10,000, and now then the firm expects obviously to recover its $17,000 in net working capital. So how does this all work? Well, we have to include some formulas, right? So what were the proceeds from the sale of the old asset? Well, $50,000 is what we received, but we have to calculate the tax. Again, that's something that we can obviously do with our spreadsheet. So we're actually going to receive $43,700 net from the sale of the new machine. The tax proceeds on the old machine, again, net's going to be about $7,900. So the total terminal cash flow is $52,800. And of course, that's a formula that we'll have to incorporate here in our worksheet. So how does this project look for us? Well, we're going to spend 181. We're going to get 18, then 44, then 52, then 65. Then we're going to get 150,000 last year. That's the timeline that we'll use for our capital budgeting project. What discount rate do we use? As we've been speaking, it's the weighted average cost of capital. So again, just to kind of summarize the information, right? We have three cash flows: the initial investment, operating cash flows, and the terminal cash flows. These are all done after tax, right? They represent, in a cash flow sense, whether money is actually coming in or out in any particular year, right? Are we doing better or worse, since excess cash is better than no cash? And of course, once we've estimated this, that's when we apply our capital budgeting techniques to try to understand whether or not it is feasible, economically feasible, for us to do this project. Glad you could listen to this video. I'll talk to you soon.